welcome back to the Everyday Growth Advisors, where we learn, compound, and grow as investors and traders. This is week number 3. Yep, that's right. If you haven't caught the first 2 videos, please go back into my video repertoire and check out the first 2. This week is going to concentrate on transitioning between passive investments and active investments. So without further ado, let's go ahead and get started. I'm going to actually close out passive investments first, and then we can move into the active investments part. So just going back to what we had spoken about in the end of the previous video about historical returns. The S&P 500 has a 88-year period where 60 years were a winning period. And if you were passively investing during this period, you would have had a much bigger term gain than a loss. So you would have seen a net increase in your account. And this is one of the most attractive things about passive investments. You don't really have to care about what decisions you make. You invest in the same thing, VOO or SPY, over a long period of time. You keep buying it every month, every half a month, every 6 months, whichever you can afford. It's, I think, $200+ a stock. And a share of the index, and you just keep buying that over a long period of time. Now, to close out passive investments, if you are a trader that does not beat the S&P 500 year after year, you should invest in the S&P 500 in the end. Because let's put it this way: if your returns are not higher than the benchmark, which is the S&P 500, why go through the hassle, right? I mean, it doesn't make any sense. Why would you put yourself through the pain, the torment, the anguish of going through passive portfolio management, doing the news reading, learning everything? There's no point. If you don't beat the stock market, you might as well invest in the stock market. Majority of people who don't beat the S&P 500, they practice active strategies, lose. And so the best way is actually to do the passive investments, as I posted in the previous videos. So that kind of concludes passive investments, and now we can move into the juicy stuff, which is active investments. So the important thing to start with is to visualize your journey. And I like to tell people all the time that you need to know where you are headed before you can even start your journey. So if you want to start trading, you have to remember that you have to start with paper trading. This is something that people always forego. They start with putting their real money in, and then they lose, and then they feel terrible about themselves, and then they cry over it. And quite honestly, it's not the right way to do it. You got to set up an account with the broker that has a paper trading function where you can trade fake money and get used to the system before you even put your real money in there. So for the first year during your learning process, where you're learning about trading, I would highly recommend to go paper trading. Don't invest your real money. If you can't manage $1,000 of fake money, there's no way you're managing $1,000 of real money. I'm just putting it out there. It's just basic common sense. Now, the next 15 years or so, you're going to be concentrating on these active strategies, and you have primarily 2 strategies where you invest in stocks or you invest in options, which are the derivative products of stocks. So options are a financial instrument that depend on stock prices. And if this is done correctly, you could really compound your wealth quickly. And by the age of the 15 years after you start trading, you will actually be able to start dividend investing and index investing. And this is how you will eventually achieve your financial freedom. So let me make this pretty clear. All traders, they end up with this as the end goal. You want to be able to make enough capital so that you can put your capital into self-producing stocks. So your return on investment should be passive in the end. But it's hard to get to a passive portfolio when your portfolio is small. So the compounding takes a long time. And so to speed up the process, most traders do active strategies so that they can build the compounding rate quickly. And there are many different ways you can do this, which we'll get into later. After which, at the age of around, let's say, assuming you start at the age of 25, which is a really good age to start, by the way. If you start a little later, it doesn't mean you're doomed. It just means, you're going to have to basically put in more capital into seeing the returns. And at the end of 65, you'll be in a period of perpetuity where you have your financial freedom. You can retire and you will be receiving dividends from your hard work that you put in these two periods. You will be seeing the results and the juices during that period. So this is how you visualize your journey. Have something in your head where you're looking forward to, okay, by this year I want to be here. I want to start accumulating, maybe about $30,000 to $40,000 worth of S&P 500 in the first, 15 years, or I want to trade options and make this much of money, and then plan out how much you need in order to retire. So I would work backwards from how much you think you need to retire. All right, moving on. Now, in the long run, where you were in perpetuity, this is what an ideal portfolio composition that has fully diversified risk would look like. So you would be looking at a portfolio with 30% dividend stocks, 30% index, and so this is a very large diversified risk with the passive stream. And then you would have slightly higher risk, which are REITs, which are real estate investment trusts. We will get into this a later part, but if you want like a short answer for what REITs are, they are essentially, you don't need to buy a house in order to own a house. You could buy a real estate investment trust that owns houses, and therefore you're buying a piece of a house. The same concept of buying the stock market, you could buy a small piece of property by buying a REIT. And then next would be commodities such as gold and oil, and because these are precious resources that are finite, they would increase in price over time. So you want to hold a small percentage so that your portfolio is hedged against this risk. And then lastly, you want to hold about 20% of treasury bonds to offset all the high beta, which is the risk of your portfolio. And this will essentially give you 100% where your portfolio is going to be fully diversified, and you can retire in this account, from this account. The passive income that you receive from dividends and your index fund dividends, as well as the income on REITs, would give you enough money to retire for sure. So now that you have done the hard work visualizing your journey, and you know what your end dream is, let's go start to the beginning. So you need to go choose a broker first. And in America, you have a choice between two brokers. The first one is called Robinhood, which is really a beginner broker, kind of for people who are just starting out. And there's no account setup minimum, and fees are also free. Actually, all brokers are now free. They've kind of recently changed that. But Robinhood has a competitive advantage where their interface is sleek and it's very easy to use. So it's perfect for the beginner who's just getting into stock trading. If you are from an Asian country, you're going to have to find another broker. I would recommend to register with Interactive Brokers or some other broker that's not so complicated, that has a sleek interface. And then, of course, with Robinhood, you have 3 day trades per 5-day trading period. So every 5 trading days, you have 3 day trades. And this is kind of how the interface looks like. It's very sleek and easy to use, very intuitive, and just makes logical sense. Everything's pretty much like, nicely panned out with a very nice user interface. The other flip side would be TD Ameritrade, which is, in my opinion, for advanced traders. But if you are a person that knows a little bit about financial markets, I think that jumping onto TOS, which is the platform Thinkorswim that TD Ameritrade offers, is actually the most logical step. It also has a 0 startup minimum. However, they do charge 65 cents for every options trade, which honestly is negligible if you think about it. Yes, it will build up over time, but you're going to make far more money from that 65 cents. So. And then the reason why I choose TOS is because it's a very, very powerful analyzer for trades and advanced traders. The platform looks a lot like this, but they have a kick-ass options analyzer that gives you really nice a view of the different types of options that you can play, and also advanced strategies such as butterflies, iron condors, vertical spreads, and it kind of visualizes everything for you. And the same 3 days per 5-day period. Now, one big difference between TOS and Robinhood is the customer service that I've seen. And don't get me wrong, it's not wrong to have both brokers. I do have both brokers. I use both of them because sometimes there is lag between processing times for my orders, and so I like to have the opportunity to use both. And so this would hopefully help you to narrow it down a little bit. I'm going to make a second part of this video right now, so stay tuned and click on the next one. And thank you for tuning into this one.